This is our big week with all the meetings, and we can see that the market really didn't want to do a lot ahead of this. You can obviously see what happened on Thursday, trying to get through this level where we all got liberated on the 2nd at the test, the pullback, the test, and now we're just sitting here and everyone's waiting by bated breath to see how this is going to go. But you had some huge developments out there, not only with stuff like smart money, dumb money, but there's a lot of people that are looking at this market, in my opinion, the wrong way, where they're looking at this and saying, oh, we're in a bubble. I'm going to explain in great detail why that's not the case. As always, it's my opinion, but we're going to get into it in some detail today on how to look at this macroly, how to look at this on the technical side. I do think you have to look at the fundamentals of what's going on as well, but let's clean all this off for a second, and then you can just see the simplest of things. So here is the ES on the weekly. You have this huge down bar, and then you have this amazing piercing pattern. And then from there, you just engulfed this other bar right in there, and then you just lifted and broke out right over the top of the control bar. So if this was anything else, most people would be looking at this and saying, oh, we're clearly pushing here. But you have this massive divergence that I love to talk about between expectations and reality on what's going on. No one can argue that earnings were fantastic. There's no one out there that can say we didn't have a good earnings quarter. We did. I think technically you're wedged in here, and I think you have difference between outcome and expectations. And we're going to talk about why that's really dangerous for people and what side of that you're going to want to be on. I usually want to be on the side of history, right? Because they're the ones that get to, the winners are the ones that write it. So, but again, the breakout sideways, one could even say that you're forming a bull flag here above that control bar. But wait, there's even more. 27.5% of you that watch these videos do not subscribe. I'm not talking about even first-time subscribers, but people that have watched these videos for more than 30 days. YouTube gives you all these great statistics. All these videos are connected. They all link together. So when they start on Saturdays, it's like following us through the week. I would also click all notifications because these videos, as you are aware, if you are a long-time listener, first-time caller, you know that they come out at different times. All right, let's do it. Now, in front of you is rate of change. And I do like using this because it's very telling. To me, all I care about is exactly what it says, the rate of change. The rate of change right now is going up. If you break a zero line on rate of change, to me, it is a weekly buy signal. If you look when you broke the zero line right in here, you can see from there you lifted. These tests of the zero line and then lifting off of it are also buy signals, and you can see that very clearly here. You test, retest, and also breaks of this to the downside. Yep, you put the brakes on and you want to see what's going on. Sometimes you get false positives on this. Sometimes you don't get false positives, like here in August 23. When you broke, you went down. When did you come back? When you flipped it really in here. And there are cleaner signals. Like when you start lifting up through it and making higher highs like you did here, you will get cleaner signals like you did here. You got that higher high signal, and then you've been lifting ever since. I also do look at this on the daily. I think that that's super important for people to do. When you look at this on the daily, from my perspective, I just don't want to break the zero, because if you break the zero, then it means that the rate of change that you're about to experience is going to be negative. And you don't know if you're going to get the wonky stuff where you're just going to trade sideways and then you have to use the control bar as kind of a guide, or you're going to get these big drawdowns. You don't know what you're going to get. You just have to monitor it, in my opinion. And for that, you could also use different kinds of tools to see how this is going to go. But when we look at this on the daily as well, we can see what we're doing. We're kind of flatlining. I don't mind the flatlining. Flatline all you want. What we don't want here is on the daily to break that zero line. And certainly this is really important because I just went through it on the ES. You're crossing. Well, you're trying to cross. Now, between what we have going on with the Treasury Secretary over there and all the rhetoric coming out here, are we going to break out? Are we not going to break out? I think you have to lean towards the fact that, yeah, you have a shot here, but there's a lot of other moving parts to this. Now, if you take a look at that wick from there, which is the peak VWAP, you're kind of sitting there and you didn't really get through it. Drop it through the daily, and you can see that you're sitting right at that peak kind of level as well, and you're unable to get through that. So this is, of course, an issue. And there's some other stuff here that I think is worth mentioning before I start getting into some other indicators that I think are super helpful. Let's take that off for a sec. And what I want to do here is just drop the 200, drop it like it's hot. The kids still say that, right? So when you have this NDX sitting here and you bonk and you bonk and you bonk, right? Complete Matumbo 3 times. You have the doji. Dojis are signs of uncertainty. This being resistance makes a lot of sense. And the reason it makes a lot of sense is because you have a death cross. As I like to say, and I like people to understand, Once you break the death cross from here, let's get rid of it. Once you break a death cross, most people are like, oh, I got to short the death cross. No, that's not what you do. You wait for it to retest this level. When it gets up here, that is your resistance, and it's acting like resistance. So this death cross is doing what it's supposed to do. People come out and say, oh, you just sell the death cross. It's the dumbest thing you could do. So what you do is you wait, and this gets into reflexivity, outcome versus expectation. And then people don't understand like why then they short and then why this happens. So again, here you are. So you have to respect and go, hey, I do have a death cross. Hey, it did hold here. Am I going to flip? And you could say, yeah, well, we're going to put a lot of other indicators in here. We're going to look at this. Maybe the 12 cross and the 22 screaming up might make you think that, yeah, there is that going on. And yeah, we are going to flip it. And we are seeing signs of that, sure. But you have to respect that. And you also have to take a look at it here from my perspective on the SPX and realize that you have the same thing going on. Now, here it is up here and you're not near it. Also, we always look at the breadth, but you can look at the breadth too on the NASDAQ 100. And that is just NDTH. And everybody should have this on no matter what platform you have. Now, I don't really look at moving averages on this. What I look for is demarcation lines. And what you'll find if you take the time is by putting this out here, you're going to see real clear that you have an issue where if you're under the 50% line on stocks that are in the NASDAQ 100 versus stocks that are above it, that's your demarcation line. You will note that the day that you broke this on March 10th, your life never got better if you were a long trader, right? I mean, you could have traded around it, but if you were one of those guys that, spray and pray or buy and hold, all of a sudden you weren't as smart. It got harder. You actually had to learn how to trade. That's a very different kind of market versus up here and everything's rosy and, I just need to buy dips over and over again. That's why those strategies, the same strategies that worked in here, don't work when you've broken things like this, because why? The internals have changed. So people are using the wrong tools. You have a trending market up here versus a non-trending market. If you don't stick with the flips, that's when you start running into issues. And I cannot stress that enough. I really would focus on this and I would watch this like a hawk. I tend to focus on the breadth here. Let's flip to this. And for me, the breadth is doing what it needs to do I'm above the 50% line, which makes sense. We're flatlining on the 20 now, which is good. And the 5 is dropping, which is good. If the 5 drops and the 20 flatlines and the 50 and the 200 keep doing what they're doing, that means we're rotation. Rotations are a sign of, quite frankly, a bull market, whether or not you want to bull. And we're going to get into that in some detail here. But what you're seeing is you're seeing exactly what you want to see. This is perfect. When you see this, you need to pay attention to it. I cannot stress that enough. When you see this, you want to pay attention to it. It's doing what it needs to do. I'd like to see us flip through this 50% as well up here as on the NDTH. But I want to go back to these indicators. One of the things I like to use a lot is the New York Composite and then the McClellan summation, not just the oscillator, but the summation. And this is telling you pretty much no. I'm just going to point out the obvious, and then you can tell me why I'm wrong in the comments, which people love to do, which I do appreciate because I want to hear other people's opinion. But I'm not going to get into what the summation is. We've done it too many times ad nauseum. You can see right here that you're already flipped this level, which to us is a positive divergence because it's already telling you that the breadth here and how this is expanding is significantly better here than it was there. But that makes no sense, right? Say it, he's got to flip. So your breadth is better here than it was here, but you're not higher. So this is going to take time. Everyone knows this. You take the window down and you take the stairs up. And that's great if you're a long-term buyer. It gives you opportunity. I do think you need to be cognizant of this. And do we get to the zero line? Do we flip that? Or do we hit the zero line and get Matumboed? That can happen. I would say historically, if you look at this, can it happen? It's happened before. It's happened back here where you were grossly oversold, rallied to the zero, rejected before flipping it. And it's not like it's a be-all, end-all where all of a sudden your life is better. But there are things here that you want to pay attention to. Like it's a thing. It's not the thing. It's a thing. But yeah, I pay attention to that. Like when I see stuff like this, yeah. When you broke here and then you were still going up, I definitely pay attention to it. So when I break that and then I see it coincide with something like this, Yeah, that's super important to me. And it is something that I think is worth your attention, worth your time. And so that's just McClellan summation, but there's more with the index. Now, I like using the histogram. If you watch this channel, you know that I do look at the MACD on certain times, just the lines. And I just use it for a confirmation. What is really going on out there? So you can see the low here on the MACD. You can see that you're over the 0 line on the MACD. Does that mean that we're out of the woods? No, you still have the 200 up here. And this can always roll over again after getting up here. But you have flipped it. So you are above with the MACD itself and the signal line. You can see before how if you're under this, it's super important to get. What else I really like to do with this kind of stuff is just drop a pin, which gives me a line, and say, hey, have we been down here before? The fact that the MACD is this oversold, and I'm gonna say this on a lot in this video today, the fact that I've got worse oversold indicators during tariff talks than I do for a global pandemic is absolute insanity. That I have more panic here for tariff talk than I had for a global pandemic. And this really speaks to where people are as far as fear. And you're going to see this in other data like Michigan consumer sentiment. When you start seeing these overlays, it's absolutely crazy to me on how people are looking at this stuff, right? And I'm not saying that they're wrong. Maybe they're saying something. So you always have to think this way, like maybe they're saying something that I'm not saying. So let me just drop that one to the 0 line. I should just actually highlight the 0 line, myself, but right around there. But the same thing you're going to see, and look at this. Watch. The same thing you're going to see here, where here you are and then here. So why the panic in the NASDAQ versus this? And does that mean that you should be looking at this and saying, oh, that means that you should be buying the S&P versus the NASDAQ? No, I would say that what it's really telling you by looking at the same thing here as you just looked at here, I would argue that no, it means that there was a huge overreaction in tech that was greater than anything that you just saw in the S&P. And that would lead me to believe that I would rather go out there and buy tech because there was a gross overreaction to it. Now, the reaction is the reaction, so people can say, well, how can the reaction be over? And that's very true. Now, I want to show this on the weekly too, because you got to look at these weekly charts right now. And that's very true. Like you broke here on the weekly, you really don't want to do this. But again, you have that 0 line here, and this is going to start driving me nuts, draw my 0 line. I'm not really sure why I'm rid of the 0. What we'll do is we'll do 0 lines. Oh, there we go. Yay. In my situation here, and looking at this, I don't really want to break that 0 line out at all. What I want to do, I just want to make sure that I'm above it. There's certain things here, like I don't really care that it's trading and it's not lifted. That doesn't mean anything. What means something to me is when I broke that 0 line, because I know flipping the 0 line is when everything starts getting like groovy again. I do know that, and that's a sign for me. It does take a long time for that to happen, but it's definitely important. Now, if you go and take a look at the Qs, you're going to see that you're in the same boat. NDX, you're in the same boat. That's definitely an issue. And I just want to point out how on some levels, how nuts this is, where, yeah, here's the weekly NDX, and I got to the point where I was at a 28 reading, which got us to these levels down here, which bottomed before in 22. But the panic here, don't get me wrong, this was the slow grind where no one was ever going to use a computer again. And this was really hard to compare because you just had Itchy dumping like $1.8 trillion on the American people, when they kept selling the Fed balance sheet down. So what you have here is you have a situation which I think is much more comparable. I mean, we don't usually go straight like that, but that's what happens when the government just buys everything. JPEGs become NFTs or whatever. Good luck with that. Anyway, if you see how this is going here, April 7th, and the bounce that you're getting on this stuff, I think it's super important to get that concept out there. Now, if I take a look at this on the daily, again, I'm above that level, which means I'm no longer what? I'm no longer oversold, and now I'm going towards overbought. That's an area of interest as well. But you really have to focus on this and go, all right, well, I get that. But at the same time, and here you are in the weekly, and you can see this. And look at the move, again, commensurate with the difference in the NDX. It's worse here than it was before, which is why I'm leaning there. What I would take from this, and what I think super important for people to get from this, is that when you see these kinds of divergences, you really want to pay attention to it. I get looking at this stuff, and I understand that, I started this whole premise with, hey, you have to watch these averages up in here. Super important. But you also have to look at the underlying fundamentals. Like, why is the dollar all of a sudden getting back over that 100? Is that something of substance? Why is gold doing what it's doing, where you're clearly starting to form what? I mean, it's very clear you're forming a top. Anyone that can see this. Doesn't mean that some news can't hit and affect that top, but here's the divergence back here. And then here it is just getting worse and worse as this goes on. I mean, you're falling off a cliff up. Super important to get. And at the same time, why are we seeing something like Bitcoin just absolutely rip people's heads off today and be setting up these bull flags that look like you're going to take out all-time highs? We're going to get to all that. But the most important thing you should be taking from this is, this talk of, are we in a bubble? I personally just come out with my own opinion. You have to make your own. I think it's laughable, but I read a lot, and I'm going to give you some excerpts here of something that I read in a shareholder letter that came out, and I think it would really help you. In front of you is an excerpt, and it is from a letter written by Oak Tree Howard Marks. And this was actually in February, but what I do is I put all these newsletters and everything that I get, all my research, and I pretty much get every piece of research on the street. I know it sounds nuts, but I get them all, and then I put them in a Dropbox, and then I save them, and then I can sort for them. It helps me a lot to keep everything collectively together, and then I can draw back on it. And this was a really good example. A lot of people keep using these terms, bubble, crash, etc. Howard Marks has been around for about 50 years at this point, and seen a lot of things. And he's really looks more at the credit markets and the income markets, but he's been around forever. And what's important about this is a lot of people are looking at the market right now and saying it's a bubble. I think you need to really take a step back and look at this and say, are we in a bubble? Are we not? And what I'm referring to here is the AI bubble. And is that true? Is the stock market currently in a bubble? Is the NASDAQ in a bubble? Whatever you think's in a bubble, I think this criteria, when you look at it, is very helpful. So there's a couple slides here, and then I'm going to give you examples of where we actually are right now. And then you can look at the data yourself and how I'm viewing it, and we can go from there. But what he talks about here is the investment lingo and how it's thrown around and how people say bubble and crash, whether we're down 80 basis points or whether we're up 2%. And I do think they're thrown around a little too much. But one of the things is the mainstream media uses them broadly. I agree with what he's saying here. Consider them to be subjective and not objective. And I want to tie this together to, you'll remember Wednesday's video when I used the phrase that I use a lot, which is reflexivity, and explaining how I look at things, where the outcome is versus the expectations, why trading on earnings is so profitable. You can go back and look at that on Wednesday's video. It's why I tell everyone that when you get into these videos, you want to make sure that you subscribe to the channel, click all notifications, because they're all linked. They'll stay linked and then they just move as time moves. There's parts of this that are exactly what I'm talking about, where when you've been doing this forever, and I have been doing this for 50 years, I think it's going on 26 now, but when you're looking at things like this, where this is such an important line, and people are going to just go right over it. Today, the mainstream media uses them broadly. People are considering subjective to objective. Tell you enough that it's state of mind, it's psychology, and it's where the masses are that makes the difference. A bubble or crash is more a state of mind than a quantitative calculation. End of sentence. Could not agree more with what he's saying here. In my view, a bubble not only reflects the rapid rise in stock prices, but is a temporary mania characterized by, or perhaps better resulting from, the following: highly irrational exuberance. Greenspan did say this back in the day. And the whole market panicked for about an hour before it went right back up. Outright adoration of the subject companies or assets and belief that they can't miss. Massive fear of being left behind, and if one fails to participate, FOMO. Resulting conviction for these stocks, there is no price too high. What I think is really good about having these, and what you might want to do is just screenshot these, is taking a look at any time in history, for example, taking a look at right now, and do you see any of these signs? It doesn't matter what I think. I have my opinion. It matters what you think. But I would really focus on this and look at it and go, do you have irrational exuberance? Does everyone feel that they have to be in the market right now? Does everyone love tech right now? Does everyone feel like they're missing out? Is everyone willing to pay anything to be in these names right now? And what I love about when these guys write is they give you books, because everyone that's been in the industry, they usually are pretty avid readers. And so what, like his one's Manias, Panics, Crashes, A History of Financial Crisis. There is nothing so disturbing to one's well-being and judgment as seeing a friend get rich. No price too high stands out in particular. When you can't imagine any flaws in the argument and you are terrified that your office mate, golf partner, brother-in-law, and competitor will own the asset in question and you won't, it's hard to conclude that there's a price which you shouldn't pay or buy. It's kind of interesting. So to discern a bubble, you can look at the valuation parameters, but I've long believed psychological diagnosis is more effective. I've said this a million times. People look at the PE and say the PE's here, the PE's there. That's relative to what people are willing to pay for. Whenever I hear there's no price too high or one of its variants, a more disciplined investor might say, but of course there's a price that's too high, but we're not there yet. I consider it a sure sign that a bubble is brewing. Obviously, we're not hearing that right now. He got this advice 50 years ago and he shares it. And again, this is why I love reading these letters, because, everything just repeats itself. It's just the new thing. It's always the new thing. Back then it was probably a copy machine or a fax, the buggy whip. You just go through the whole thing through time. Anyway, I've written about this several memos, but in my opinion, I can't do it often enough. There are 3 stages of a bull market. The first stage usually comes on the heel of a market decline. Cough, cough, nudge, nudge, wink, wink, or a crash, and has left most investors licking their wounds and highly dispirited. At this point, only a few unusually insightful people are capable of imagining that there could possibly be improvement ahead. The second stage, the economy, companies, and markets are doing well. Most people accept that improvement is actually taking place. In the third stage, after a period in which the economic news has been great, companies have reported soaring earnings and stocks have appreciated wildly, everyone concludes that things can only get better forever. So if you had a list like this and you had to look at the market at any given time, you'd have to kind of conclude what stage of the market you're in right now. Now, the document was about 16 pages long, so I just took a couple excerpts out of it. The important inferences aren't with regard to economic or corporate events. Super important. They involve investor psychology. It's not a matter of what's happening in the macro world. It's how people view the development. So one of the things that I always say in the community is the following, because there's this bias. Let's say you have good earnings, and then all of a sudden that stock goes up. Well, you would expect that stock to go up on good earnings. That would be the expectation, and then that would be the outcome. But what if the exact opposite happens and the earnings come out and the stock, well, that would tell you that the sentiment of the market is the issue, not the earnings. See, everyone believes just because you have good earnings that you're going to go up. That's not the case. That's an assumption. It's a logical assumption. There we go again, thinking. But it's not the case. Sometimes companies could be way ahead of themselves and actually pull back, and the exact opposite could happen too. They could have gotten absolutely smoked for no reason, like we just saw recently on a lot of names. And what tends to happen when they just even do the simplest of things? The stocks on bad earnings actually do what? They actually wind up going up. Super important concept to get, because it's not just about the stool, which we talk about the macro, the fundamental, and the technical. It's not just about that. What part of this we're sitting on. It's our perception of it and how it's perceived. So it's not just a matter of what's happening in the macro world. It's how people view that development. And I can give you examples of this. I can give you really good examples of this, quite frankly, on the macro side that will be, as someone likes to say, absolutely glaring. Sometimes some things are just glaringly obvious. So let's look at this thesis a little bit and see what we say. So in front of us, we have Michigan consumer sentiment. And what I love about the market is they'll take a turn, they'll say something, any turn, and they'll try to spin it. And then they'll take something that we all know what it is, and then they'll change the terminology. That's the new thing. Soft data, hard data. Soft data is sentiment. Sentiment indicators are what people think are going to happen. It's not, we're calling it soft data, but it's sentiment data. It's always been. Why is Michigan consumer sentiment doing XYZ? Well, this is how people feel. That's why it's doing what it's doing. So up top is Michigan consumer sentiment. One of the books that I have told people that I've read and helped me greatly understand this stuff in these cycles was reading The Hedge Fund Edge by John Boucher. I would strongly suggest that you read it. What I have here is just us going back through time, and what we'll do here is how far back? We can go back to, they'll take us, we'll go back to 03. Let's go back a little further. Go back to 79, see how far they'll get, because then I have to zoom in and everything. So we'll take this 90 area here, and you'll see this little blip right down here on your screen, and they won't let me blow that up, but you can see the blip right here. You'll see the other ones as we'll get involved. And really, I mean, you can't miss what I'm getting at, hopefully. Glaringly obvious. And we'll just drop a line right there. And we can see that this is when people felt the worst about the market. And we can see this blip down here and then lift. And what you're going to see is when you mark these off, that you're going to find those areas that, and it doesn't even have to be, every single low. But when you start seeing these areas like here, and then you mark them off, yeah, you could dip and then you could go lower again, like you did here. But eventually one of those dips like here is going to mark that bottom. And you're going to see this time and time again, where these lows, well, that one didn't work. It would have been way better if it worked. These lows are going to mark us in levels. This usually is a leading indicator, by the way. This usually happens, and then it will tell us like, hey, a month from now or something, this will change, but the market's already going to be reflected. And hopefully you can see where I'm going with this. But what's important to us about this, and I'll clean this off, is that it's not once, it's all the time. It's not once, it's like, what was the lowest reading during the great financial crisis? Oh, it was down here. Oh, okay. How did that go for the market? Oh, it's the bottom of the market. And then here comes Michigan consumer sentiment hitting another low. And at the same time it hits that low, the market's actually higher, hitting another low. Well, what does that tell you? Well, now I have a positive divergence on the Michigan consumer sentiment data because I'm not hitting a new low, even though this is where I'm at. Super important concept there. But what this is telling us is, oh, hey, by the way, you're at that 55 level, and that's where the great financial crisis. Hey, here's the retest of that. Oh, that was the bottom. And that's as far as we got down. So again, when we start going through these levels, you can see hopefully where I'm going with this, where here's 22, and this is where I'm just going to mark it off now so you can see it. From our perspective, this is where we are. If we mark it here, okay, great. We dipped right here in 22, and we hit, and then we went down again for a couple weeks, and then we bottomed, and then we ripped everyone's face off after hitting this level. And then you look at this, and just to kind of put this in perspective, because it's, quote, soft data, as we're supposed to refer to it, or sentiment data. And then when we look at this stuff, what's it telling you? Oh, by the way, the sentiment was better in the market than it is right now, even though we had a massive shutdown of everything global. Everything was better here than it is right now. Like, that just shows you the psychology of what you're looking at. Because there's no way that people could feel more certain, on any objective basis. It's impossible that people could say that they feel more certain during a global pandemic than they do right now. It just defies any logic. You're welcome to comment on that. Maybe I'm missing something, but when the entire world is shut down and we don't know what's going on, versus we don't know what the tariffs are going to be, you can still go outside, you can still walk around. I mean, when you really think about it, like how crazy that is, and it just goes to show you psychology of the market and market sentiment. Super important concept. You might want to listen to that part a couple times. Really important, but watch how this plays out. Is the Michigan 5-year inflation expectations. How do people think of inflation year over year going forward? This is what's happening right in this area since 23. You could see this rise, and people are like, no, inflation's not going anywhere. We're fine. Inflation's ripping their faces off. And they're like, oh, we're fine. Inflation is dropping throughout here. And what's happening? No, things are good. Inflation comes in negative on the month-over-month data. So on the CPI, month-over-month, 4.5 up here. So the idea that in the perception of where you're at versus where you truly are at are so skewed right now that somebody might want to go back and listen to those things to look at to determine where we might actually be and which one of those stages we're in. Because sentiment has shifted so far negative that, in my opinion, it's very difficult to look at this on the earnings you just had and say that we're going into some kind of recession. I understand the levels of uncertainty and economic uncertainty, but where sentiment is versus where we are is so skewed. It's crazy. And I can give you an example of this on hard data as well. If we look at the S&P and we look at hard data, right here was the single highest CPI we ever had in well over 5 years. It was right at this level. This one in October was right near it. It was like 9%. This was the bottom of the market. Now, if I go back in time, and I show you the tweet that I put out that no one's going to ring a bell, this is what a bottom looks like. And what I did was I showed this chart. I just put this out on Twitter, and you can see the lower low, and then you can see the right here, the higher lows. And I said, no one's going to ring a bell. We undercut it. We couldn't hold it. And it looks to me like we're putting in that bottom. The amount of rhetoric and the amount of psychology in people's minds that we're so used to just getting torn apart, I couldn't possibly be right. You couldn't possibly bounce at this. So no matter where your head is or what you're thinking, or this time it's different, right? I mean, remember, every time it's definitely different. And that's how people view these. They keep doing the same cycle. We repeat patterns. So when you start to see this thing and everyone's like, oh no, this is going to roll over and the tariffs are going to be, 4,000 and this is going to happen and that's going to happen. You have no idea what's going to happen, because here's where they told us we were going to have 4% GDP. Here's where they told us we were going to have negative 4 GDP. Remember the Atlanta Fed? They kept wheeling that sucker out. You don't hear about that anymore, do you? So when you start to see this stuff, you have to understand that it's the psychology on where you think we are versus where we really are. That's the game in a nutshell. So I've been getting requests to show more trades. This was a super simple one to show. Super easy trade, actually, but there were some real interesting developments, and I'm going to show it live in a second. But we saw the volume coming in off the open on this one, and we were focused on a couple other names. You might hear me mention it in the editing of this. But essentially what we're doing is buying in here on the break, and then we got the retest. We actually were buying in here, and then as soon as I broke, I cut half. Saw something that showed me how to get in here. It was the amount of volume that came in after this right here. See how much that is See how fast you bounced on that little volume? Sometimes these low volume bars will tell you more about the price action than the high volume bar. See like how the high volume bar broke you out and then you came down? You'll see me actually trim into those until you'll see like the final reason we got out. But I actually trimmed, and this is something that people are lost on, and I think it's really I think it's a really important concept that people have to remember. You can always get back in a trade, always. Pardon the slurping, it's early at the time recording this. But you can always get in a trade. You can't always get out at the same price. So when it does something that it shouldn't do, you just get out of the way. And this did something it shouldn't have done, that doji, the undercut. So I just moved on, and then we just got back in when we saw it hold exactly where it should have. And that's super important to get. But let's watch this play out live. But I do think that that's going to absolutely rip here. You can see a 3-handle here today. If you look at how this is setting up, your wicks right here, but there's more to it there as well. There's this close over that area right here. I'll get to it later, but this can go. You can go here. You should be able to see the cup, the wonky cup, and the handle yourself. You see the handle right here, see the cup. You can get up here pretty quickly. If you flip this level, pardon me, allergies today are brutal for some reason, weird. But 301, you get through that, there's nothing here. You can get right up here, like fast. So just keep that in mind and let it do its thing. Nothing for me to do with this. I'm just sitting with it. I already have it. I'd be looking for pullbacks and ways to flip that level. 301 is pretty much a lock. It's actually a little lower. You probably already flipped it. You already did. So 301 is probably like a layup, guys, to get to here, which is like 3 points if you want it. And you have to use this low. You could drop to a 3-minute, see if you can find something else like that, 294 level to get there. I'd rather go off the 5, but you haven't had one bar yet. I don't think you're gone, man. I'd like a pullback, but I'd like a lot of things. I don't think I'm going to get it. You over? So come on down. Find a way in to buy more Tesla today. I think that's going to be a fun one today. I don't know that I have to do it right now. So I'm just going to wait and hold what I have. There's your first pullback. What's the low? They're going to fight the 300. They're going to lose. They're going to lose. But you're going to lose. They're going to fight it. It's only going to cost me $1. I'll know in like a minute or two. They can't get through. But I got to use that low. So it might be a super, super quick trade here. Because if it doesn't do what I want, then that means they're going to apply a lot of pressure. Yeah, I don't really have that 50% there, but do what they do here. I'm just trying to scalp it. I have more on. But like once that happens and it pushes through what you're looking for, you said you couldn't get over half of that. It was kind of telling. You see like the LPI here, the HPI here. So what's the low of that bar? So right there, when it did that, I just printed more of it because it held. And then I just used the same stop at 41 just because it was just sitting there. I'm like, well, it's not going to cost me much. Like, what's it really going to cost if it doesn't break, right? The little loss I took up here, I bought that position back. Now, if it flips and goes, right, because now I could trim more of that. Why would I do it now? Because now if it holds, now I got something. Come on, there it is. Boom, trimmed. So you want to be in here for it. So when it does it, you're trimming. Trimmed. I'm just trimming that day trade I did. I'll talk about this in a class, like why I did that here, why I bought back. I have half of the day trade left if you're trying to figure it out. See, I'm not telling, like when I'm looking at the stock, I'm not telling the stock what it's going to do. I'm just allowing it to act. Your first down bar, first bar really under that cloud. Day trade's over 100%. Now, I hope you found that helpful. I find the comments, I read a lot of the comments. I don't mind sharing those things. I don't want to do it all the time, but I do think it's helpful. If you want me to get into like greater detail on that trade, I can do an entire video on it. I don't mind doing it. I do understand why people want to say it, and I do think that it's helpful to an extent, especially when you're doing the live and then you can see that. And when I show that trade, that's from one account. There's accounts where I compartmentalize my trade. So I have accounts where I will have my long-term holds or conservative accounts and then aggressive accounts. I find compartmentalization to be key for me because what would happen with someone like myself, and everybody's different, you have to do what works for you. You'll hear me say that a lot, is if I had like my swing trade in the day trade account, I'm going to think I'm super smart. I'm going to get out at the top and then I'm going to buy it back. No. For me, that would not work. So there will be days, for example, where I'll take MSTR and I'll whack it around, but I've had a trade in MSTR since like 310 or 317, I think. That if I was in the same account and I'm watching days like this when I'm day trading it from 430 to 406, and it becomes an issue. So I think that's super important for people to get. But Anyway, I do think there's some things here that are definitely worth us going over. I do want to go back to the Tesla, and there are some names here that I think that I could add real value to that would help you this week and going forward. And I think there's some things that we really have to cover that happened on the earnings front that could really add value as well. But if we take a look at something like a Tesla, for me, the break was everything. So here's your flag, here's your break. And of course, you have the China talks, and everyone's going to be like, well, we don't know what's going to happen. No, we don't have a clue. We can say that we do. We all have become experts on China. Again, here's your death cross. And everybody's like, I got to sell because I got a death cross. All right. So from that death cross, if you bought the death cross, you're up about 70 points right now. And now it's telling you for the first time, and I would pay attention to it, that you are above the 200-day moving average. And you are above the 200-day moving average on Tesla for the first time since it broke here. You kind of got above it a little bit there, but you're really above it now. And you had some decent volume. I mean, it could have been better, but it's a lot of volume on Friday from a lot of people that either don't want to be short it or realizing like, hey, if you're having talks, things are going to get better. Now, maybe, you hear all over Twitter, oh, this guy's going to walk out, that guy's going to walk out. Letnick, who, in my opinion, at this point, he needs to shut up. I don't know how else to say it nicely, but like, when you have a point person, the other person shouldn't be saying a whole heck of a lot. But, I guess we could do a video on that. They shouldn't be contradicting one another. It's definitely counterproductive. And that kind of stuff can add to the volatility. But if you look at the forest through the trees, what I was trying to explain to everybody was that's your neckline. Everyone sees the left head right in the development. The bigger the right shoulder, the more pain. And that's why this was so painful, right? The less developed the right shoulder, the less pain. But if you look at something like this, like to get to 320 is not a big deal. Again, what I would do is focus on the fact that that you're in a non-trending market. So you have to watch the top of the VWAP and go, oh, okay, well, I could see why that peak right there could be an issue. And that stopped us at 307. So you're going to want to watch that, of course. But there's other stuff here that I think super important with Tesla, and I would be paying attention to. Make sure that you do get the trading free newsletter because there's going to be a lot of like tips and stuff in there. I would focus on the fact that from this peak, and this to me is more important than the VWAP. VWAP secondary to volume profile for me. I'm above point of control. Point of control to me, like if someone said rank them, point of control is greater to me than VWAP because VWAP is telling me that all these people are in from here. Point of control is telling me this is the price point where everybody owns the most. That's why point of control is more important to me. What's more important to you is what's more important to you. To me, looking at this and saying the majority of people own here versus this is the average price all these people own, they're both important. Don't get me wrong, and I watch both. But if someone said, hey, what's most important? Also, closing above like this value high area, you kind of might want to pay attention to it. I know people don't like when you have like no volume in here, like it's no man's land to them. I like no volume. I'm an optimist. So I will look at that and think, oh, I can get up to that 325, 330 level. That's the top of this bar and go from there. But you still have some issues here. I do like what you're seeing here. I would not really sleep on this. I personally think one of the things that you're going to hear about with this open market and China is that, because that's where Trump was going with it, what he's saying about the open market, I'll give you my opinion with NVIDIA. If you want access to everything that we have access to, then you have to allow your people to have access to everything that they want access to. And you can't have these subsidized car deals on your own cars in your own country versus everybody's cars. And if you're going to do that, then we're going to do it here. I think that that's where that's going, and I think it could help places like Tesla or help NVIDIA if they have an open market. If you start breaking down some of these barriers, I think that that's where this could go. And I think that you could see this move. In my opinion, from what we're saying, China needs this to happen more than the US does. I don't know that you're going to see more deals. I don't know how that's going to go. But when we look at something like NVIDIA in here, we have some really core issues to focus on. And I could do the simple things like drop in the moving averages and we can talk about them and go, ooh. But I really like that you are back above the 50 here, the 55. I use a 12, a 22, 55. I love this cross here where I have a 12, 22 cross. I have a whole trade that I do just when this happens alone. We do have to drop the 200 in. We do have to recognize that you do have a death cross here. And we do have to recognize that that does make that 125 level pretty hard to break on NVIDIA up here. I do think that the time that we utilize everything here that we should spend on some of these earnings, because a lot of people looked at these earnings and just felt like, oh, there's not really a lot here or a lot to focus on. I would take the other side of that with some of these names, like KLAC is the one that came out that had earnings. When these guys start coming out like this, these semiconductor capital equipment manufacturers, I want to pay attention to them. This is super important. I would watch AMAT because AMAT is, I think, Wednesday or Thursday this week. You want to watch this, and you definitely want to watch this because of this. Taiwan Semi. This is Taiwan Semi when they came out with earnings. Couldn't get anywhere. Here's your death cross. Here's your 200-day moving average. You want to watch AMAT. And I'll tell you why, because I think they're ramping up production. I don't think they're cutting back production. And that ties us back in again to the ASMLs of the world and people going, well, I don't know what to do with this. And you can see your break right here and how you're acting. From that break, you've done nothing but rally. What I thought was super interesting about this week is a lot of the color that we got. And what I mean by that is D-Dog. Take a look at this. You beat. And then you go TTD. And we take a look at how that's going. And you beat. And if you go through these names like Net and Cloudflare, this to me was okay. It wasn't great, but it was okay. And you rallied on okay. So then I start looking at things like the cloud. And you start seeing that you're doing the same thing. Here's your death cross. But what are you fighting? That 200-day moving average. I do think we're getting a leader. I think our leader is IGV, which is expanded tech software. Now we're going to need more coffee today. But what I want to focus on is there's my death cross. Say it with me. Ooh. But what happened? You flipped it. We need a leading sector. IGV used to lead the SOXX, and I know a lot of people don't get this, but back in the day, we knew this. So if I go IGV here, and then I tie this into the SOXX, you'll see this pretty clearly right here. And we'll just flip to it for a second. Now, let's do it on the weekly and go from there. And you'll see from like that 2000 on that this was just an absolute battle with these things flipping over and over again. But once you got through this level back here, and then we'll slide this over. Once you got through the great financial crisis, everything was restored. And then what happens was we go through this period. And once we go through it, you can see how that played out. Now watch this. But wait, there's more. Watch what's going on in the hourly here and how this is starting to set up from the 25 on. Well, what's happening here? You're getting a leading sector. The leading sector is IGV. IGV is leading the SOXX. And when you go back throughout history, it's really important to get, let's go back to this, that's always been the case. It just has been because IGV, this is the entire sector versus just one component of it. But you had this period in time where you didn't have that. And you can see this, that like if we go back, we'll do it on a 4-hour real quick, where you had these periods where you had this outperformance. And then that outperformance of the SOXX is flipping. Super important concept to get, guys, because when you see stuff like this, like here's from the pandemic, I don't know where I'm from, but here's from the pandemic. Then if you go back, so everything, like let's look at it this way, like nature's healing, right? So this is really what you want to focus on. I do have a leading sector. And then you would kind of go through those and go, well, what names are in there? I'm glad you asked. I think that you have to focus on stuff like Oracle. Let's clean all this stuff off for a moment. But I think you have to focus on things like Oracle now. I think you have to pay attention to this. And what you might want to do is watch these moving averages on things like Oracle. But software names overall were great. And I always look at like the big short names. APP, you broke out on this. Yeah, they're leaning on that sucker a little bit. I'm a little surprised by that. But yeah, they're leaning on that guy a little bit. They're selling it down. And they're able to do that. I was watching CVNA as well going, man, they're going to rally that one. And they're leaning on it. So what this is telling me is that I am at this crossroads. And I really want to, there's so much in this video. And I spent a lot of time editing this one. And I don't know if that was right or wrong. But trying to cut down the time. And the one thing I'm going to take from all this is I do think the IGV space is something. But when I see the most shorted names getting to the highs like this, and then they're rolling over, it does mean that you want to pay attention. You really want to pay attention, and you really want to have your levels marked accurately. That is it.